This is System Trader Show, episode number 16.
Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
Meb Faber is a co-founder and the chief investment officer of Cambria Investment Management. His specialty is quant investing. Meb is the host of the Meb Faber Show podcast and has authored numerous white papers and books. He is a frequent speaker and writer on investment strategies and has been featured in Barron's, The Wall Street Journal, The New York Times, and The New Yorker. In this episode, we talk why you need an investment plan, why the systematic approach is helping to have a better decision-making process, how to behave in the period of a market crash, is dividend investing a right approach for most of us, and many other topics. Only practical knowledge, no nonsense theory. Enjoy. Hello Meb, and welcome to my show. Thank you so much for accepting my invitation. I'm sure that many of my listeners know you already, but just for the pure formality, could you please introduce yourself and tell us a bit about how you started your career in the investment field?
Sure, great to be here. Thank you for the invite. Like many, I'm sure it's a windy road. I was an engineer by background, undergrad, studied biology and engineering at university, and had fully planned on a life of a scientist. My brother and father were both in the aerospace part of the world, and was curious to follow them. But you know, like many, I was interested in being an astronaut, like many youths. But once realized there was a lot more math and physics involved in being an aerospace engineer than being an astronaut. And so anyway, I had fallen in love with biology and genetics. This was in the late 90s during one of the great bubbles of our lifetime, investment booms with the internet, and but also in biotech. And so I decided to take a year off, as my other brother had advised me to, before going back to graduate school for a PhD program, to make a little money, to enjoy the real world for a year or two before going back into academia, and have the opportunity to work my other passion, which was investing, for a investment fund focused on biotech that also let me go to graduate school at night and study biotech. So it was really kind of a perfect blend. And so did that for a year or two, and then kind of just kept gravitating further and further away from my career path and more towards my hobby, and vice versa. And next thing you know, fast forward a few years, was focused more on the quant side of the world, and then started my own company. And then that was, 2005. And fast forward, 15 years now. It keeps getting longer. You used to say 5 years, 10 years. Now it's 15. Here we are in a new decade, in a new time. And I hope everyone's safe and sound listening to this. But things have been a little crazy already this decade. And the career became the hobby, and vice versa.
Right. Could you please tell us a bit about your company, Cambria Investment, some history about this company, and what kind of services do you provide?
Sure. So we're a institutional investment manager, meaning we invest money for not just individuals, but other institutions. You know, the goal in the beginning was really, like many people, I imagine, not quite sure what we wanted to be when we grew up. You know, started the company in my 20s. Here I am in my 40s, and had some ideas and philosophies about how to invest money that was a little bit different, probably from a lot of the status quo of what a lot of other companies were like. And so, over the years, have evolved to where we offer 11 public investment funds, ETFs, here in the U.S., and they all have sort of a common umbrella of what you would say the similarities are, namely that we only launch funds or strategies that we think don't exist, or we think we could do better or cheaper. You know, in a world of infinite choice, you go to the grocery store, there's 30 types of milk now, or 100 types of chips. I mean, same thing with investment funds. There's tens of thousands out there. And so, you know, what do we think? We have the ability to offer something better than companies that manage in the trillions like Vanguard. So it has to be something a little bit different, or we think we could do better or cheaper the ideas in general have to be something that I want to put my own money into. It's shocking to a lot of people, but a lot of fund managers actually don't invest in their own funds, which is a sad state of affairs for a number of reasons we can get into later. It has to be something that's based on what we consider to be a fair amount of academic or practitioner research. So a lot of ideas that you see out there are a little bit half-baked. You know, they don't really pass the scratch your head, common sense sniff test of, is that something I could explain to my high school age, niece or nephew or child or cousin, and really, or grandparent, and it makes sense. And so, two of our biggest pillars, and I'm sure we'll talk about later, are over 100 years old, the ideas. So it's nothing particularly new, and you can kind of look and see how they've done over the course and arc of history, and those being value ideas, and then momentum and trend ideas. And then lastly, and the hardest part for me is always, is it something anybody wants? And so we've offered these funds for over the past, 6-7 years now. We'll probably launch maybe half a dozen more. We'll probably settle in that mid-teens range. Never have 50 or 100 or 1,000. But my problem is that we keep coming up with crazy ideas that I think are brilliant, and then no one else is doing. So who knows? Have me back on in a couple of years, and we'll revisit.
All right. As you know, I'm living in Europe, and here we have a problem that basically most of the individual investors, they don't have access to ETFs, which are listed outside of the European Union, because due to the European Union regulations. Are you maybe considering to meet some requirements of the European Union which would allow having access to your products, to your ETFs for the European investors?
I would love to. The European Union is making our lives, everyone who's a fund manager in the U.S., very, very difficult. And you could probably come up with reasons why that may be. But it's some pretty onerous regulations. The problem for us is some of them conflict with some of the U.S. regulations. And so it makes it of sort of questionable legality to be able to comply with both. It's kind of like asking both of your parents for permission to do something, and one says, yes, you can watch TV tonight, and the other says you can't. Well, you're probably in trouble either way. So it's a hard hurdle. We would love to, believe me, I would love, a lot of our investors are all over the world. We would certainly like to be able to offer our funds everywhere. At some point, we may just launch funds in Europe. That's certainly not in the cards this year, but we'll figure it out one day, whether it's by trying to figure out the regulations or just launching individual funds in Europe too.
Sure. Thank you. You describe yourself as a quantitative investor. Could you please explain what does it mean in details? I mean, how it helps in investing or in having, let's say, a better decision-making process?
Well, I think it's a lot simpler probably than the phrase implies. When most people hear quantitative, they think that it's some high frequency, super complicated machine learning or artificial intelligence algorithm. But really all that it means at its very core is, do you have some rules? And those rules could be really simple. It could be, hey, I put half my money in Belgian stocks and half in Belgian bonds, and I rebalance that once a year. Well, that's a quantitative approach. Or it could get a lot more complicated, and we're somewhere in the middle. I think, and this year is a pretty great example, is that the biggest problem by far with most investors is we're human and we let the emotions creep in. And that could be applied to anything, any walk of life, any human arc that you have, where we know that when we evolved thousands of years ago on the savannas of Africa, we weren't genetically predisposed to run towards the lion, right? That didn't make any sense. But those sort of genetic artifacts in our lineage doesn't lead us to trading shares of Amazon and Google and all the other country interest rates and commodities and everything else. Many of these ideas are counterintuitive to what we would normally expect to be, our emotions tell us. And so being a quant allows us to say, look, I'm going to set up some rules that let me logically ahead of time implement some ideas and strategies that when the heat of the moment comes, and 2020 is a good example already, as many markets around the world are highly volatile, many declining with some speed a lot of investors have never seen before. And so unless you have those rules in place, you behave emotionally and irrationally, which almost universally is the exact opposite decision you want to be making. So at its core, it gives you sort of an anchor or a guidepost that lets you base decisions on. We think it's essential, not just important, but essential that investors have a written investing plan. And that doesn't just apply to institutions, but also to individuals, to advisors, and everyone in between. And not only a plan, but one that's based in historical expectations. So many investors just want to extrapolate the most recent past into the future to infinity. But really, to be a great investor, you have to not only study history to see what has been possible, because many, if not all markets have had extreme events on the good and bad side, but also to realize and take a step further and say, okay, at some point, the future will exceed those bounds and be even better or even worse than what we've seen in the past. Because we really only have 200 years of probably what we consider to be modern capital markets, really only 50 years of modern currency markets. You can, of course, take the share exchanges back to the 17th century in Amsterdam, right down the road from you guys, I think was the first global stock market, but people were even trading futures in Japan prior to that. So history helps to have a guide. And then once you have sort of expectations, you can put into practice some rules, at which point it makes you, I think, a lot better investor. And you can take advantage of opportunity when other people were freaking out and losing their minds. And again, I would like to stress throughout this conversation, it's not just individuals. A lot of institutions like to look down and say these irrational, human, crazy people. But believe me, many of the institutions are just as bad, whether you manage 1,000 euros, 1 million, 1 billion, or more.
Right. But do you think that investing is more an art or it's a science, or maybe in between?
I think it's seductive as a quant or a numbers person or an engineer to want to try to make it as exact and precise as possible. Universally, some of the worst investors I've ever met, we have over 40,000 investors. Universally, some of the worst are the smartest people in other professions, doctors, engineers. And because they're so smart, they just assume that their knowledge extrapolates into another field of investing. But also, you got to remember, investing is like playing poker. It's not an exact, or blackjack. I guess both are good analogies for different reasons. But it's not an exact science that if you have a valuation model that says a stock's undervalued, well, the world doesn't have to agree with you. One, and two, the world can change. And the hardest part, and I think mistake almost everyone makes, is they care more about predicting the future and being right than about making money. And so, some of the best, most intelligent quants in the world that have been Nobel laureates, that have managed billions of dollars, have blown up funds that, and have gone to zero. So hubris, of course, being one of the worst emotions in the investing world. So I there's a blend of both. I don't know if I can make an argument. I could make the argument probably either way, but depending how you define either, I think there's a natural balance that is somewhere in the middle.
Right, I understand. I see that you mostly are focused on, let's say, the macro view, rarely describing any single stocks. Do you think that stock picking as such is just too difficult to do so, or maybe it's not even worth to do it, or maybe there are some other reasons why you're not so focused on single stocks, but you rather look broadly on the market?
I absolutely believe that people can pick individual stocks. Now, I tend to agree more with Warren Buffett and Charlie Munger. Charlie's right down the road from me here in Los Angeles. where people ask him for advice, and he says, look, if you're a young person investing or looking into investing in general, he says, you should go where the fish are. If you're a fisherman, and not go fishing where there's 1,000 other fishermen in one pond, but go to the pond or the river where no one is. And what that means to me and translates to is, look, if you're trying to divine that you have a better discounted cash flow model for Apple than all the other top investment banks in the world, and it's $1 trillion company, good luck with that. But if you become an expert in Nigerian banks or paper companies in Indonesia or, Belgian plastic part makers, whatever, where there's no one else, the competition's not that hard. The equivalent being is like, hey, are you trying to compete with the best Messi and Ronaldo soccer players in Europe, or are you going to go play the local, university team in a small town? You want to find an area where there's less competition and less efficient. And at the end of the day, you have to have either better data, so you have a model that's better than someone else's, or you have insights that is better, or you have to have different data that no one else has. So have you talked to, say, that Nigerian company's suppliers and employees and the CFO, and understand, hey, they have this relationship with the government that's not baked in. So I think there's absolutely opportunity to be a security analyst in any asset and to become an expert. I think the bigger challenge is, for many people, is, do you have an edge? And to be honest with yourself. And most people, I think, falsely believe, and many knowingly, that they think they have an edge, where you start to drill down, and really it's this false sense of security about their ability to really be a stock picker, because it's really, really hard. Believe me, if it was easy, then we would all be billionaires, and we're not. So it's absolutely possible, but like this, the same applies to business, by the way, and the free markets all over the world. If you're great at making lamps, God bless you, you become the greatest lamp maker in the world. You'll make a ton of money, but guess what? Other people would love to make billions of dollars making lamps too. So it invites competition. So really the whole key is to find an area that's not as much competition, that may be less efficient. That tends to mean smaller companies. So what we would call small or micro cap companies, probably under 500 million in market cap, maybe under 200 million in market cap. But wading in the big waters doesn't mean you can't buy these stocks and make money. Certainly, you could probably buy Apple and Disney and Pfizer and make money over the next 20 years. But to really outperform, and we can get into all the parts about that later, you have to be better and different, and that's hard.
Right. I mean, the funny thing is that mostly the beginners are starting with stock picking, and so it's like they are probably not even aware of the fact that the odds are against them, but they are still just quite often starting from investing using the stock picking approach. You mentioned already that you believe in eating your own cooking, meaning that investing your money in your company's product is important because it shows that you also believe in what you do. It's just fair. Could you please then explain to us a bit more in details now exactly your investment plan behind the so-called Trinity portfolio? Because you just put information on the website, also on your podcast, that basically all your investable money you just put into your fund. What are the three pillars behind that strategy, if you could just explain?
Oh boy. All right, let's dive in. So when you think about the public markets, let's start as broad as possible, and then we'll get more specific. We always tell investors that the great starting point is if you just went out and bought the entire world. And what does that mean? If you bought every public security in the entire world, you end up with a portfolio that's roughly half stocks, so half equities of businesses all around the world, and about half bonds of all the various types, government bonds, corporate bonds, et cetera, et cetera. in about because of size and because the U.S. is the world's largest market. U.S. is the biggest allocation, so you'd end up having about half in the U.S. and then a smattering of all the other countries in the world. The U.S. is less than half the bond markets, but that's roughly a good approximation for today. There's a couple assets that are missing out of that pie, and that tends to be single-family housing and farmland. But in general, it's a pretty good approximation of what's if you just bought the world. So that's a good portfolio. You own stocks all around the world. You own bonds all around the world. The problem with and that probably beats most investors' portfolios over time. Historically, if you go back to the 1970s, that does high single digits, maybe even closer to 9-10% per year. That's in a higher inflationary environment. We're in a low inflationary environment now, so maybe call it 7% a year. But great returns, over time. But the problem with a basic buy and hold portfolio. Now, the good news is, particularly in the US, and this is coming for Europe and the rest of the world, you can buy that portfolio for essentially free or almost free. So there's no commissions now for most brokerages. And then the management fees on that portfolio are darn near close to zero. So 0.05%, which is pretty amazing. There's never been a better time to be an investor as far as those fees. So that's the base case. The problem with the buy and hold portfolio over time is that it has what we call drawdowns. So meaning if you have $100,000 or euros in this portfolio and in 2020 it goes down 20%, you're now down 80 to the 80,000, or it goes down 50%, you're down to 50, whatever it does. That's what we call drawdown. So a peak to trough loss at one point. So a buy and hold portfolio goes through those. That's natural. Every asset does. And you can't avoid it. But the problem for people, going back to the intro to this discussion, is people are emotional, and it's hard to watch a portfolio decline in value and not do anything. People feel, in any other endeavor in the world, you could work harder, you can intervene and do something. With investing, you just got to kind of sit on your hands. And to be a good investor, you have to be a good loser, because markets spend over 2/3 of the time in some form of drawdown. But that's the toll, or that's the price you have to pay to have the good returns over time. So the problem with buy and hold, and people are learning this, particularly the younger cohort this year, is that it often coincides with bad. It's happening at the same time as bad economies or bad geopolitical events. So it all happens at once. So it'd be one thing if your portfolio goes down, but you have a great job and the world's all great. That's another thing if the portfolio goes down at the same time a pandemic is occurring and you lost your job and you have no money. It all happens at once. So it's what we would call a kind of double correlation, where you're adding risk rather than diversifying or really having a situation that helps rather than hurts. So that's one, and the buy and hold allocation actually doesn't matter that much. People spend 90% of their time thinking, is gold expensive? Should I have this much money in bonds or this much? What about stocks? Is it time to get in? Is it time to sell? What about commodities? Is oil cheap at $20 a barrel? Is it, all these things that people spend time on. And we wrote a book called Global Asset Allocation, where we looked at like 20 very famous asset allocation strategies of the most famous gurus that manage trillions of dollars. Everyone from Dave Swinson, who manages the Yale Endowment, to Robert Arnott, to Warren Buffett, to Mohamed El-Erian. All these people have recommended at some point an asset allocation, and they're very, very different. So Buffett famously says, look, when I pass away, put 90% in the S&P and 10% in bonds, and that's it. Other people say, no, you want 25% in gold and only 25% in stocks. And other people say, no, you shouldn't have anything in gold. So they're hugely different asset allocations. Well, the surprising part is, over time at least, it really doesn't matter. We looked at most of these asset allocations, and over the past 50 years, the returns over time cluster within around a percentage point of each other. which is astonishing. Now they take a little bit zigzag paths to get there, but if you're a long-term investor, it really didn't matter that much. But what did matter was how much you paid in fees. So if you paid, the average mutual fund price in the US is 1.25%. And remember, I just said that you could invest in a portfolio of ETFs and low-cost funds for darn near zero today. Well, the spread in performance between the best performing asset allocation and the worst was less than the spread of how much you would pay in that mutual fund. And so people focusing on something really boring like fees and taxes is actually more important than the actual asset allocation. So that's a great base case. You do a global asset allocation, you get three of the main ingredients: stocks, bonds, real assets. And real assets, is like real estate, commodities, TIPS, which are treasury inflation protected securities. You have a little bit of all those. And again, you can't have just all your money in Belgian stocks and Belgian bonds. It's got to be global. Once you have that recipe, doesn't matter if you have 20 or 30% of stocks. Doesn't matter if you have 50 or 40 or 30% in bonds. As long as you have some of each, you should do okay over time. But more importantly, you should pay very, very little in fees. I'll pause there.
Right. And the great thing is also that now you can do it just buying one ETF like TRTY, and basically you're covered. I mean, you have everything. You have all these assets under single ETF. So that's really how easy it's now to invest in the 21st century.
Yeah. And so in the departure, so that's what we call the global market portfolio. So we have an ETF that does that. It's called GAA. And it does some tilts that we can talk about later to value and momentum. But it gives you this nice balanced global portfolio across all asset classes. But it has some of the problems that I mentioned earlier, which are, it tends to decline when markets in general are declining. And so there's another investment philosophy, which is what we call trend following. And trend following, also goes back over 100 years, the time of Charles Dow starting the Wall Street Journal, and probably way before that. But it's basically an investment approach that says at its core, you want to be investing in markets that are going up and not in ones that are going down. Sounds simple enough and a lot harder to implement in the real world. But there's a lot of very simple indicators and algorithms you can use to basically say, is this market in general going up or is it in general going down? I mean, a simple one would be, is the market up over the past year? Is it down over the past year? Is it above a long-term average or is it below? And basically what you're trying to tease out is the signal from the noise, and you want to avoid the really, really long, deep bear markets. So you're not going to miss the ones that are down 10 or maybe even down 20. You want to miss the ones that are down 50, down 80, down 90. And people are probably shaking their head listening to this and say, well, my God, what markets go down 50, 80, 90? Well, almost all of them do at some point in time. If you look at oil right now, you look at a lot of country stock markets are down that much. So a trend following approach simply says, hey, look, and we'll use U.S. stocks for an example. If it's going up, you want to be in. And when it rolls over, when it goes below long-term moving average, or your signal tells you to get out, you simply sell it and you sit in cash or bonds or whatever your safe asset is until it gives you a buy signal again. And in general, historically speaking, trend following gives you roughly the same returns as a buy and hold allocation, but with lower volatility and lower drawdowns. And more importantly, it does it in a way that's not as correlated to a buy and hold portfolio. And so you could take all the assets that are in your buy and hold portfolio and say, look, I'm going to apply my trend following approach to each one. So I'm going to apply it to US stocks and also to foreign stocks and real estate and commodities. I'm only going to be investing in these when they're above their long-term trend. And trend following suffers from a lot of other problems. If markets are going sideways or oscillating, you tend to get a lot of false signals or what we call whipsaws, and that kind of is a cost over time. You're never going to pick the top or the bottom, but really you want the meat of a move. The bigger problem with trend following is you end up looking different. So you look different than your neighbors. You look different than the institutions. In a year, perhaps last year, where U.S. stocks romped up 30%, you're probably going to underperform. And so that's also a hard emotion and system to stick with. Going back to our old friends Warren and Charlie, he says, I can't tell you how many times, I can't remember if it's Warren talking about Charlie or vice versa, but I said, can't tell you how many times Warren said it's not fear and greed that drive markets, but envy. And so the problem with trend following is envy. There's many times when everyone else is making hay and are doing wonderful, but you're not. So if the S&P is up 30, you may only be up 10, or you may be flat. And so being different, and particularly different when you're wrong, is hard too. Now, the good news about trend following is traditionally it does a better job in the bad times than buy and hold. So in a year like 2020, in a year like 2008, 2009, early 2000s, internet bubble, trend following in general traditionally does a better job. So this whole Trinity concept was the yin yang combination of both. Say putting half in buy and hold. So you have 1 foot in the real world. You have a tether to a great portfolio that simply buys and holds assets for the long term. And then you have trend following, which says, hey, we're going to try to limit the downside in case we have another financial crisis or Great Depression or pandemic, who knows, that causes assets that go down a lot. And the two together should be able to create a portfolio that, at least behaviorally speaking, people can live with. It makes it a little easier to survive, which is really all that matters at the end of the day. Is, can we create a portfolio that lets people earn returns, but survive with as well, and not panic at the worst moment and sell everything?
So basically, if someone is really dedicated to investing, just buying such fund is exactly enough what such person needs, if only that person is able to stick with it. But let's say that we have a person which is trying to, let's say, do it on its own and is trying to, as we mentioned already, do the stock picking. And you mentioned in your books, on your podcast, and on your website multiple times about the yield investing and dividend investing. And you dedicated quite a lot of materials on that topic, especially in the context of taxes. So my question is, what do you think about dividend investing? Is it a good strategy which you could recommend, or it's just a kind of, let's say, different flavor of value investing?
I'm going to channel John Bogle, the founder of Vanguard, who recently passed away, where he said, look, he was talking about index investing, but it's irrelevant. But he said, someone asked him about it, and he said, are there better investing approaches? Probably. He's like, this one works for me, but are there worse ones? He's like, there's infinite worse. And so I'm of the belief that there's a lot of ways to invest just fine. We just did a 4-part series on our blog called the Get Rich Portfolio, the Stay Rich Portfolio, how I invest my own money, and then investing in a time of Corona. And again, those are free on my blog. And I neglected to mention that book earlier. Most of our books are also free on my blog and website. And so let's say you told me, hey, Meb, I'm just going to buy a basket of stocks, put money in each year, 10 stocks I like, hold them for the long term. Like, that's fine. Maybe you said, no, I have 80% of my money in short-term cash and bonds because I'm super risk averse, and 10% in real estate and 10% in stocks. Like, whatever works for you, whatever lets you sleep at night is most important. So when you're talking about strategies, there's opinions I have that are clearly very opinionated. There's others where I'm like, it doesn't really matter. I'm not super strong opinion. Dividends fall under that category of, to me, is it a nonsensical investing strategy? Yes. Is it okay? Is it fine if people do it? Also, yes. I don't like strategies that don't really check the common sense box for me. And let me explain. So if you're a company and you're a public stock, there's really only 5 things you can do with your money, and that's it. You can reinvest in the business, which is what most people think when they think about companies: launch new products, do R&D, build new buildings, hire new people. It's all the sexy part about operationally running a company. You could also pay down debt to the extent you have any. You could go acquire another company. That's the third one. Or you could buy back stock if you have cash, or you could pay a dividend. And that's it. Those are the only 5 things you can do. Everything falls under one of those 5 things. And so there's a lot of investors out there that say, okay, I'm going to follow a strategy where I invest in stocks that there's a lot of flavors, but let's say they have a high dividend yield. I only buy dividend stocks above 5%. And so what are you getting there? You're getting a company that has cash or is making cash and is returning it to you as a shareholder. And why is that a good investing strategy? Well, the company has to have cash in the first place or make cash. So at least it's a company that is in business and plans on staying in business. But often you're getting companies that are older. They're not necessarily very innovative. Because they have a high dividend yield, the stock is probably cheap. So on average in history, dividend stocks traded about a 20% discount to the broad market as far as valuations. Now, they tend to be a little higher leveraged, so they have more debt than a normal company does. And that's it. You have no other characteristics. So really all you're getting is kind of a value tilt for a junky older company. Now, historically, that does outperform broad market cap weighted indexes by about a couple percent a year over time. Now, we have to take a step back and we have to talk about what market cap weighted indexes are, because a lot of people, I don't think they really appreciate the basics. So when you talk about a stock index, whether it's a index in any country, we'll use the U.S. stock market as an example, whether it's the S&P 500 or something else. But if it's a market cap weighted index, you invest the most in the largest stocks within that index. So in the U.S., that's Amazon, it's Apple, all the way down to, say that if it's the Russell 2000, say there's 2,000 stocks. And the problem with that index is there's no tether to fundamentals. There's no, it doesn't matter if the company has sales. It doesn't matter what the PE ratio is. It doesn't matter if it's a good buy. It doesn't matter on valuations. It doesn't matter dividend yield, anything. It's simply how big is the company measured by stock price. And that's a weird way to come up with an index. But historically, it was an interesting way starting in the 50s and 70s because it takes zero effort to manage that portfolio. So you can do it for a very low cost. And going back to what we talked about earlier, cost is a huge input into your total return to the end investor. So, but it's somewhat also of a nonsensical investing approach. So any weighting methodology, you could equal weight, you could weight based on value, you could weight based on dividends, you could weight based on letters of the alphabet, should beat market cap weighting. So dividend falls under that category. It does beat, but it's also terribly tax inefficient. So you have to pay tax, well, many countries, you have to pay taxes on dividends here in the US every time you get a dividend check. So theoretically, and we wrote a paper on this, you should prefer companies that don't pay dividends if you're a long-term shareholder. All of that having been said, is it a fine investing approach? Sure. Many worse investing approaches absolutely. Everyone who markets dividend funds, they've come up with but the actual approach, I think, is pretty nonsensical. Now, I'm one of the few people on the planet that believes this. So listeners, take it for what you may. But I think it tends to be something that just doesn't check that original box of making any sense.
By the way, Warren Buffett's Berkshire Hathaway has paid only once a dividend in 1967. And Buffett said that I must have been in the bathroom when the decision was made. So that's what he thinks about that. So he really thinks about taxes and why they are inefficient in the context of dividends. But still, why is it so popular among individual investors? Is it something magical about the cash which is paid to the investors that they are really following such companies which are paying cash?
I think the part where I said that they have a good brand, I think it's created almost with check, as if companies with the returning part of the capital. So, the company is really very minuscule, self-liquidating. Now, the bigger, particularly here, but I'm sure all around the world, around the topic of stock buybacks, who has the opposite problem, which is the absolute horrific branding because people don't understand them. A better phrase for stock buybacks would be called tax-efficient dividends, tax-efficient flexible dividends. And the problem is that people just don't understand what they are. And it's a mathematical fact that if taxed at the same rate, and if the stock is trading at its intrinsic value, a buyback and a dividend is the exact same thing. And you can't argue that. I mean, that's just a mathematical proof. And so why do people get so upset and inflamed about stock buybacks? It's a good question. I think they think that they correlate stock buybacks with executive compensation, and really they're two different issues. Executive compensation is a board issue. How much you decide to pay executives, if you're paying them $100 million, that's on you. I mean, that's the board. That has nothing to do with buybacks. Now, if they tie them to buybacks, again, that's a stupid decision by the board, and it has nothing to do with the tool, the hammer, which would be buybacks. But Buffett gets it. As you mentioned, he's never paid a dividend in the last, 60 years. But what he does do is he buys back stock. Now, he's smart about it. So he's not just buying back stock at any time. It's foolish to buy back stock of a company that's expensive. And Buffett sets a very basic metric for valuation. I think he says we'll buy back Berkshire stock when it trades below 1.3 times book. And I think it might even be less now. I think it's trading around 1 times book now.
It's around 1.
So he may be putting money to work this quarter as the markets are in turmoil. But he said, there's no better use for a company's cash if a stock is trading far below intrinsic value than stock buybacks. So he gets it. And then Charlie Munger, his partner, talks about, you want to buy the cannibals. You want to buy the companies that are reducing their share count. And the flip side of this coin is also issuing shares. So all three of those combine into an equation where you want companies that are returning this cash as opposed to issuing shares, et cetera. The branding and the descriptions and believe me, no one gets it more wrong than the politicians do. But politicians are going to be politicians the world around. They like a good soundbite and boogeyman. But in general, the whole key that we're looking for here is the word value. Doesn't matter if it's dividends or buybacks. Like, you can buy a company with a 7% dividend that is really expensive valuation, and that's really foolish. You could buy a company that's an expensive valuation that's buying back tons of stock. Also foolish. The whole key is you want to use valuation as your core, as your foundation, and then be able to sprinkle on everything else around it. So having that value approach is really the main compass versus all these other sort of levers you can pull.
I have last question in the context of dividend investing, namely the interest rates, which cannot be any lower now. How a rising rates environment affects such kind of investing, I mean dividend investing, because for the last 4 decades, these interest rates have been going down, but now we reach the floor. So what next in the context of dividend investing? Is it somehow impacted?
Traditionally, throughout history, high dividend yielding stocks do not fare well in a rising rate environment, which we haven't had in a long time. So we may never have it again. They may just keep going to 0, -1, -2, -4. Who knows? But if you're trying to hedge against a potential inflationary environment, high dividend yielders may not be the best place to be. But who knows? It's hard to say. But traditionally, that's been they've delivered negative outperformance in times of rising interest rates.
Right. I'd like to ask you a few questions about the COVID-19 because now investing is quite, let's say, interesting for many people because the markets are really very volatile. So let's talk about investing in the time of coronavirus or market crash in general and why we need a plan when investing. Because first of all, many people are asking now what to do. Is this time different? Because we have never had such case before. Can any investor prepare for these anomalies, or are they truly, let's say, black swans that cannot be just managed? Because, for example, Benoit Mandelbrot, by the way, it's a Polish-born French and American mathematician, he coined the term volatility clustering, referring to the observation that large changes tend to be followed by large changes of either sign. So how do you see what happens now in the context of coronavirus? What now? What to do? And is there any common denominator, let's say, for all market crashes?
Sure. So the common denominator is prices going down. And I say that only half jokingly. I think it's seductive for most people to get in the business of predicting what the next crisis will be. And in reality, most crises are obvious in retrospect. You can look back in the arc of history for the 20th century, and my God, you have everything. You have wars, you have pandemics, Spanish flu, and a war in the same year. You have interest rate regimes of inflation and disinflation. You have almost anything you could possibly come up with the exception of aliens invading. And maybe they did, we just don't know it. I don't know. So the normal state of affairs is disarray. And borders have changed, currencies have changed, alliances have changed. All of that will continue. Despite that, a global portfolio has done fantastic. The key, of course, is you don't want to concentrate in any one market. That's a recipe for the poorhouse. And this is a concept we talk about that afflicts every country in the world. If you're an American investor, you put most of your money in American stocks and bonds. If you're Belgian, you do the same. If you're Japanese, you do it. If you're Australian, you put most in Australian markets. And that's a really foolish decision. And it's called home country bias. And it happens everywhere. And it's just a needless concentration when in reality you should be diversifying across the whole world. And a good example is if you look at my favorite investing book, Triumph of the Optimists, it looks at all these investing markets back to 1900. And you find that some countries did fantastic, like the US. Some countries did very poor over the period. So for stocks, for example, Austria had basically no return. Russia and China shut down altogether. You lost all your money, 1917 and 1949. Same thing with interest rates. Some countries had hyperinflation and their bond markets went to zero. You lost all your money. So having an average or diversified exposure makes a lot of sense to combat the bad times. But the bad times are normal. We like to say normal market returns are extreme. That's true of yearly basis. That's true of daily basis. So people freaking out this year about these big returns. And yesterday, we're recording this, the US market printed like an up 10% day. Most people would have thought that'd be unthinkable a year ago, but it's happened in history. You have plus minus 5% days, you have plus minus 10% days. It's rare, but it's, quote, normal. So it's happened in history. And sometimes you even have a minus 20 or plus 20% day. So you have to prepare for that possibility. Now, they tend to happen during crisis. So you have both really big down and up days, which is the volatility clustering you referred to. And that's usually just because people are freaking out. That's the technical term. They're emotional. They don't know what to do. The world is in flux. They're losing money. And so markets are gyrating and it's really confusing. So those often happen during downtrends. So one of the reasons trend following works traditionally is that it tends to avoid those periods. And if you avoid the big volatility, what we like to call volatility gremlins, You can hopefully compound at a higher rate. But in general, it's a normal feature of markets. It doesn't make it any easier, but it also creates opportunity. Going back to what we talked about earlier, where if you're an investor that is logical and rules-based, you can take advantage of other people acting bananas crazy. But once you have that expectation, understanding, and studied history, you realize these really bad events occur, and it's just the normal nature of human beings to have to experience these. And usually markets end up playing out where they're really volatile in those periods.
So when the stock market pukes, like now with COVID-19, is there any, let's say, best hedge against such case, which could protect us from such events?
Yeah, so traditionally, if you're a stock investor anywhere, other stocks aren't going to help. So if you put your money in Belgian stocks, British stocks, American stocks, investing in Japanese or Australian, it usually doesn't help at all because they're stocks and they tend to move together. They're correlated. Real estate doesn't traditionally help that much. Commodities, particularly the energy-based ones, don't help. Particularly, really don't help this year. What does help? Bonds often help. They don't help a lot because they're usually not. Stocks are a lot more volatile, so you need a lot more bonds to counteract that. Gold often helps, but not always. And then you start to get into what we call these active strategies. So trend following often helps. Ideas like tail risk help. Tail risk is what I put under the category of insurance, much like you would buy a house or car or life insurance. It's usually a net cost, so it's not a great investment. But as a part of an entire portfolio, it can be because it helps protect in the really bad times like this year. And when I say tail insurance, I mean something like simply is buying options, puts on the stock market, that bet on the stock market to go down. Can be a totally reasonable exposure. But the struggle with that is that it's rare. By definition, you normally don't see markets decline as fast and as furiously as they have from all-time highs as they have this year. That's pretty rare. And so the tail risk sort of portfolio, you could have a decade of it being a cost, and how many people can sit through that. We haven't talked much about this, but any investing approach, whether it's an asset class or an exposure, or you hire a portfolio manager or active manager or tail risk, it can easily go 10 years, 20 years underperforming. We say recently in the US that one of the most widely held beliefs, almost universal, is that stocks outperform bonds. And we have evidence of that from all over history. But U.S. stocks have, well, if you exclude today, I don't know what's happening right now. The market could be up or down 20%.
Let me check.
But stocks have underperformed bonds for the last 40 years. Or not underperformed, they've had equal performance. That's a pretty long period to have a belief system not play out. And so what do most people do? They look in terms of days and weeks and months and quarters, even year or two, 3, if they're really long term. And we used to tell people if they're examining any asset class or portfolio manager, we used to say they need to give them 10 years. Now I say 20. And most people laugh and I say, I'm serious. If you're not willing to allocate to this strategy, asset class or manager for 20 years, you're wasting your time.
Right.
That sort of self-selects our investors because most people don't want that. They want the outperformance. They want it now. They're like a toddler. I have a 3-year-old. He wants it right now. He wants his cookie. Everyone wants they're magically to invest in an asset class and it go up right now. But that's unfortunately not the way this works. That's not the way any of this works.
By the way, today we have quite positive day. It's almost 3% up. So we'll see what will happen later. How much we should allocate to a tail risk strategy? Because you mentioned that basically now it's pretty easy. I mean, if someone doesn't want to trade protective put options, it's just easy. We can buy such ETF for that. But how much we should allocate for such strategy?
Let's take a step back real quick and say, let's say you have a portfolio that has stocks largely and then bonds. The first way to hedge risk is not to take it in the first place. So if this year is stressing you out and you can't sleep because you have too much in stocks, well, the simple answer is don't own so much in stocks. The second one was, we mentioned, diversify, add bonds, add gold, add some other assets. The next is tilt towards value, though that's not helping this year. That's actually hurting. Maybe add trend following. Only then do you really get to tail risk, in my opinion. And the problem there is that it's, I'm in the periphery of crazy people on one end of the spectrum on this belief, where we wrote some papers a couple of years ago, and I was actually talking about this last night on Twitter, where I said you could make the argument that if you work in the asset management world or you work as a financial advisor, you shouldn't have additional exposure to your asset class being, in my example, US stocks, because you're now 2, 3, 4 times leveraged the same risk. So if you're an airline company, they often hedge the cost of fuel. If you're a cereal company, they hedge the price of wheat. Well, what's the main risk for an investment manager who makes his money off fees is simply how much in US stocks they have. So the average financial advisor or investment manager has their own portfolio in stocks. They have their spouse and children's portfolio in stocks. They then have their client portfolio in stocks. Clients often behave poorly and freak out in bad markets. So it also declines when markets are down. If you work for a company and don't own your own business, additionally, you have exposure because that company's revenue goes down and they may fire you during a recession. So you could make the argument that you shouldn't own any stocks at all. Or if you are, which was what most people do, regardless, you could hedge them. And that's what I do. That's what my company does. I don't know anyone else that does that, honestly. Maybe there's a few crazy people like me, but in general, most don't.
Many ETFs are trading now, especially during the market stress, at discounts, and it's both for bond and stock market. We could see this, for example, for Vanguard Total Bond Market, BND, or for VanEck Vectors, Junior Gold Miners, and GDXJ. Should we take any lessons from that? I mean, are ETFs doing their job? Are they working as expected?
Simple answer is yes. The longer answer is you got to remember that ETFs are just another structure. They are basically the same as mutual funds, but with more efficient taxes. So going back to like our whole dividends and buybacks, they're kind of like the buybacks in this world. But in the big picture, as far as assets, I love hearing people talk about how ETFs are distorting markets, because ETFs are a speck of sand on the beach of assets worldwide. I mean, they barely even register. People say, oh my gosh, they have so much in assets. Well, compared to where the rest of the assets are held, they don't. Mutual funds are still 4 times the size of ETFs. Forget about direct ownership, about institutions, about the real money, pension funds, endowments, sovereigns. All these sort of big money institutions have way more invested. Now, the only thing they do get correct is any amount of flows into anything. I don't care if it's a private hedge fund or a mutual fund or an ETF or a sovereign fund. If you're putting a lot of money into an asset class that's tiny, you will change the composition of the asset class. So if you said, hey, Meb, I want to put $100 billion into Belgian companies that are small cap internet companies that focus on cybersecurity. Well, I don't know how many of those there are. Maybe there's 5 or 10, but you're going to put 100 billion in them, and they only have a 100 million market cap. Well, obviously, that's not that smart. Or maybe it is smart, but you're going to drive the valuations up a ton. But it's the same thing with anything in the free markets. So it's not the structure. It's not ETFs. It's just money sloshing around all around the world. And that's what creates bubbles. That's what creates busts, money sloshing out. That, of course, leads to opportunities. And I'm ignoring the small, very, very, very small right of the decimal percentage of funds, ETFs, but this applies to anything, hedge funds, mutual funds, private funds, whatever, that do these weird, esoteric, ridiculous strategies, like some of these volatility, VIX-based ETNs or quadruple leverage things. Not really referring to those. Those are just fall into the category of stay away. But in general, it's they get a bad name. And yes, they're working just fine is my short answer.
How do you see, just closing the topic of coronavirus, how do you see the coming months for the global markets? I mean, also the global economy. Do you think that even when the virus will just go away, the damages which are already made to the economy will be enormous, and recession is just, it's not question if, but how deep it will be?
So I wrote a recent piece called Investing in the Time of Corona, and I think it's a good example, real-time walkthrough of how hard investing is and how you have to mentally prepare for multiple possible outcomes. The problem with most investors is they get myopically focused on how they believe the future is going to play itself out, whether it's bullish, whether it's bearish. You know, there's people that say, I think the Fed's creating hyperinflation and stock market's going to go down 90% and gold's going to go to 10,000 and Bitcoin. Is that possible? Sure. Is it the most likely outcome? No. On the flip side, say, I'm so bullish on artificial intelligence and the world's becoming so much of a better place, and healthcare innovation and biotech and genetics, and I see all these innovations coming, and stocks are going to hit 100,000 on the Dow. You know, is that also possible? Sure. Elon Musk is going to invent free energy and we're going to find diamonds at the core of the moon. I don't know. But much like playing blackjack or poker, the future is a spectrum of probabilities. And you have to make bets accordingly. And the first goal is to survive. The second goal is to obviously perform well and have a portfolio that does well in any environment, both good and bad. So I outlined a bull and a bear case for Corona. I said, look, the bull case is, rest of the world follows the experience of China and South Korea, massive testing, quarantining, therapies are developed that actually work, whether it's chloroquine or something else. Vaccines are developed on fast track. The world gets vaccinated this summer. The virus dies off in the heat. Most of the emerging markets don't get it. Fiscal and monetary healthcare policies are effective. Healthcare systems are not overrun. The virus never comes back. Markets are hitting new highs by year end. On the flip side, you say, okay, what's the bear case? Well, governments react, but it's too slow. Policies are ineffective. The virus spreads exponentially everywhere. It hits emerging markets particularly hard. Healthcare systems are overworked. Stock markets decline. Risk on assets all around the world plummet. Fiscal policy is stuck in governments. It's ineffective. There's mass unemployment. The world is treatments are ineffective. Vaccines are problematic. They don't get developed. Maybe there's some relief in summer, and then the virus comes back in the fall. And it turns out that, this isn't a short-term experience, but this is something that we're living with for years, not weeks and months. And that's scary too. Are both of those possible? Yes. In the bull case, stocks are probably back at all-time highs. At the bear case, you could lose 50 to 80% and it not even be out of the question. It's a depressionary style environment. What's the most likely scenario? Something probably in the middle, but if you don't prepare for both outcomes, let's say you say, no, I believe we're going to kick this virus. It's going to be done by Easter time and we're romping and stomping back to all-time highs. I'm putting all my money in buying dip, putting all my money into stocks. And sure enough, the bear case happens and you lose 80%, which is essentially all. And you also, the economy's in the toilet and you lose your job. Well, that's going to be a tough situation to be in. And the flip side, you say, oh my God, the world's ending. I'm moving into my bunker. I have toilet paper for 6 years. What am I going to do? I'm shorting the markets, taking all my money out, I'm putting it into, I don't know, Ethereum and shorting stocks and putting it into shorting, whatever it is. And then markets rip back up. Well, you just missed out on probably the rally of a lifetime. So what do? You prepare for either outcome, I think, and build a portfolio that's hopefully robust. And for me, that's Trinity. That's the concept of having some in each, buy and hold, so that if the markets rip back up, you're protected, but also in trend following, which is mostly cash and bonds right now. Or if you're a managed futures allocation, it's short a lot of things, so that you survive either outcome. You may not be the best returns on the planet, but you're surely not going to go out of business and be the worst either.
So to be a quant investor is also very helpful in such moments, because you just have to stick to your strategy, just follow it, and that's it. You don't have to try to predict anything what will happen in the future. I wanted to ask you about the long-term investing versus short-term investing or trading. Is there any good way to say which makes more sense to you, or is long-term approach easier than trading, or it's maybe the opposite?
There's really no question that the long-term approach is the way to go for almost everyone. It requires no effort. It requires no special ability. All that it requires is the ability to save and invest and the ability to compound over time. If you put $10,000 into a child who's born and put it in a global equity fund that does 10% a year, just for make math easy, by the time they retire, when they're 50, that $10,000 is $1 million. And that's incredible. It didn't require you to read any balance sheets, any annual reports. It didn't require you to visit the company's management and talk to them. You didn't have to outperform at all. It's a simple ability of the free market and capitalism to give you investments as business owners in the best companies all around the world. That having been said, most people, it's tough. They don't want to behave over terms of decades. They'll never put things away and hold them in a lockbox, though they should. They want to trade them. They want to muck around with their portfolios. They want to freak out. They want to spend the money is the big one. Almost anybody who has investments, that's what it's there for. There's a friend, Morgan House, who says, most people who want to be a millionaire because they want to spend $1 million. They want a vacation on the Riviera. They want to drink champagne. They want to go get the best seats at a football game, which is the exact opposite of what it takes to become a millionaire, which is saving and investing and leaving it alone. So it's the simplest equation in history, and it's the most beautiful because anyone can do it, from a janitor to a truck driver to anyone who is a regular salaried employee. It doesn't require you to be Jay-Z or Beyonce. All you got to do is simply save and invest and have a fair amount of time. Can you invest on short term to take advantage of other people? You can. It's a lot harder because you not only need to be right, you need to be right and have the timing right. But there are opportunities. We mentioned some, certainly funds that trade away from their net asset values, intrinsic values of stocks when they move away at times of panic like we've had over the past week, month, that are certainly lend themselves to opportunities, but it's hard. It's really hard to get both timing and direction correct.
Right. How about then active and passive investing? Because many investors have come to the conclusion that rare events are impossible to predict, and therefore there is nothing to do other than just buy and hold their investment and wait out any negative outliers, like, for example, we have now. And also they say, this missing the 10 best days argument preferred by, advocates of buy and hold investing, and you call it as the myth. So basically you think that there is a world for both approaches. I mean, the buy and hold, the purely passive investing, and also for active investing. And also there's a question, what's the border between the active and passive investing? Because even the index as such is not fully passive. The constituents are changing in time, and there are even human decisions behind. So it's not really fully passive. How do you see that?
My belief, and I don't know that anyone really agrees with me here, is that the only true passive index is the market cap weighted portfolio we talked about earlier. Any deviation from that, in my opinion, is active. And the problem is in 2020, the phrase active passive is totally polluted. For example, you could have a passive index that our favorite example is invest in companies of stocks where the CEO eats hamburgers or cheeseburgers or veggie burgers, and charge 3 percentage points per year. Is that a totally nonsensical, foolish approach that's expensive and is not going to work out? Absolutely. But that's a passive, quote, index. Or you could have an active fund that is super well run and super low cost that only charges, say, 0.3% per year. And so, in my opinion, it's much simpler. The only true passive index is the global market portfolio. Everything else is a form of active. Now, the real question is, to me, is it discretionary or is it systematic and rules-based? And discretionary is hard. You're betting on a portfolio manager and his special Superman abilities versus a quantitative approach is what you can see what the rules are. And somewhere in between, in my mind, is what really, is where most people fit. But I fall on the quantitative side of it just because it's a lot easier. If you have a discretionary portfolio manager that's done well for a while and all of a sudden they get divorced from their spouse, or maybe they get an illness, or they're just happy in their wealth and they want to cruise around the Autobahn in their new Tesla or Aston Martin, and they're not thinking about the portfolio. That's a way harder decision than just using a simple quantitative rules-based one. So I prefer quant, but hey, if you're a discretionary person, God bless you. That's good. That's good as well.
And by the way, what do you think about the efficient market hypothesis?
I think markets in general are mostly efficient. I think people are no dummies. And so if there's money sitting out on the sidewalk, then it makes sense to go pick it up. If you have an advantage, most people prefer being rich to poor. And to the extent you can utilize your superior knowledge or data to make that happen, I think most people would prefer having wealth than not. So it makes no sense to have a market where these major discrepancies would be simple. That having been said, for various behavioral, structural reasons, they do occur. I just don't think they're ever easy. So investing in cheap countries or stocks is often hard because they've already declined a lot and they have a lot of hair and warts on them. And, an example today would be investing in like Russia or Turkey, or Brazil, which is stock market's gone down like 60% or something. There's career risk in there, and it's harder. So there's a lot wrapped in it. I think markets are mostly efficient, but if you, again, going back to what we said earlier, if there is superior data or different data, or you have better models, then yes, is it possible to outperform or superior insight? Absolutely. I don't think it's as easy as it was maybe 50, 80 years ago. I don't think it was easy then either, but the more information as enabled by the internet certainly makes the world a little harder when it's mostly freely available to everyone.
All right. We are getting to the end. I have some final questions. ESG, environmental, social, and governance. What's your opinion about that? Because that's it's becoming more and more, let's say, important sector of ETFs as well, but it's very becoming popular. I even hear people who are not even really interested about investing, but they are just going for ESG just because of their beliefs behind this.
Anytime as a quant you reduce choice and breadth, by definition, the results likely get diminished. Meaning, if you go from 10,000 stocks in your universe that you could invest in down to 5,000, you just simply have less choices. By definition, it's going to be harder. That having been said, A good example is what's the most best performing stock industry in history? Well, it's tobacco, that's probably killed more people than any industry, all the rest combined. And I say that growing up in a town where, my grandfather worked at RJ Reynolds. So, but I guarantee you that would fail basically every ESG filter, tobacco companies. The challenge is, look, do I believe that people, if they want to, should utilize ESG? Absolutely. I don't think the best way to do it is through funds. I think it's through probably screeners or direct indexing, meaning you have an advisor or you personally can screen companies out for whatever it may be. Realize, though, that the world's a little more complicated than most people think. Facebook, for example, passes all the ESG filters. Could you make an argument, and I'm not getting involved, that Facebook has done probably more harm to the world than almost any other company? You could make that argument. A lot of the old school fossil fuel companies put more dollars into research about clean energy than anyone else in the world. So investing in some of these old school companies, I don't know specific examples, but whether you say like Exxon, is that, which would fail many of the ESG filters, are you actually not focused on the right problem, which is enabling actually the growth of, it's complicated. Am I okay that people do it? Absolutely. Do it to your heart's content. Invest in the companies you believe in, that are world changing, that you care about. Wonderful. I think it's really hard to do from a quantitative standpoint because ESG means different things to different people.
Right. I have the very last question. What would be your single piece of investment advice for someone who has, let's say, decades to retirement?
This is simple. First, go listen to my podcast. Go read our blog posts and books.
Yeah, but it's like 200 episodes.
Yeah, good. Well, you got a long time till retirement. The advice is actually really simple. And the first advice is get started now, meaning today. Start putting money to work investing. It's okay if you make mistakes when you're young, when you don't have much money. It probably helps you. The scars and the very real pain, visceral pain of losing money is actually probably helpful in the future because it sets your expectations of what happens when things go down or poorly so that you know how to behave. Second is take a really, really long-term view. I think a great advice is called the coffee can portfolio, where you make an investment, pretend like you have to hold it forever, like you can't sell it, which is a pretty cool idea. You just say, I'm going to buy some shares of Disney. I put it in my coffee can and I forget about it. And we'll look at it in 30 years or whatever it may be. Two would be to write an investing plan. And it's not set in stone. You don't have to keep it forever, but at least to have a plan you can look back in. I think it's fun to keep a diary. Say, hey, this is why I bought this. Also, this is why I would consider selling this. So let's say you bought that Disney in a year, it's down 50% and you sell it. Well, was that part of the original rules or are you just reacting emotionally? A good example would be the media loves to talk about, hey, if you just put $10,000 into Warren Buffett's Berkshire Hathaway in the 60s, it's worth like $20 million today. But most people wouldn't have been able to sit through the times when it went down by 50%. Amazon, forget about that. That's gone down 95% before.
Only Jeff could handle that.
Only Jeff. It's $1 trillion company now. Maybe not today. It was beginning of the year. So, just get started. That's by far the biggest thing that young people have going for them is time. I gave a speech in Ireland this past year where I said, a lot of you are going to be facing this decision. I don't know if you have spring break, but maybe after term ends, you go to the beach. You're going to go to Ibiza. It's going to cost maybe 1,000 euros, 2,000 euros. And I said, most 20-year-olds can't have empathy with their 70-year-old self. They don't want to think about themselves as old and prune-like and wrinkled and stooped over. But I said that $2,000, if you just put it, instead you went on a backpacking trip through Bavaria or something, instead of going to Ibiza, that $2,000, you locked it away, it would be worth $200,000 or 200,000 euros by the time you're 70. And would the 70-year-old you appreciate $200,000 more than the 20-year-old you appreciates $2,000? Maybe, maybe not. Maybe you meet your lifetime mate in Ibiza and you have lots of children. So you say that was a good investment. I don't know. But the biggest thing you can do is start to think in terms of saving and investing. And pretty quickly, you'll see just how powerful that is. But again, old advice, just go listen to our podcast. That's a good start.
Right. Is there anything else you would like to add before we just finish today's interview?
No, I'm losing my voice.
Sorry for that.
No problem. I think the best part for most people and investors is to get the experience. I think 2020 is a great learning example for investors of all stripes, to be able to see what it feels like, when times are good as well as bad, to be able to start to put money to work and begin, or even for older people, to participate in a lifetime of learning and craft of investing versus just speculating it for the short term. But say, look, I'm going to commit to a lifetime of improving my situation and building real wealth versus letting myself be exposed to the whims of the rest of the world and governments and other people. But I'm going to take charge of my own personal path and my future. That would be it. And then enjoy it. And, money at the end of the day is just a means to an end to be able to enable the freedoms that we all prefer, whatever that may be. If you want to go paint in the countryside, if you want to take some more school, if you want to set up a foundation for people, whatever. You want to start a new company, it just gives you the freedom to do those things.
Right. Thank you, Meb, very much for your time today. Actually, I have only scratched a bit your knowledge and your wisdom, as I'm sure that we could talk hours, although, yeah, I know you're losing your voice. Stay healthy in these tough days. Social distancing, that's the topic number one nowadays. I wish you all the best. Thank you very much for your time.
Absolutely. It's been a blast. Thanks for having me, everyone. Please say hi on any of the social media, Twitter, email, anywhere else. I look forward to cheersing you over a nice pint in Belgium one of these days post-quarantine.
Right. Thank you very much.
Cheers.
Take care. Bye-bye.